Welcome to Beyond Investments with your host, Seth Leishman of Ostro Financial Consultants. Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but its accuracy and completeness are not guaranteed. Neither LPL Financial nor the hosts of this show or accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Ostro Financial Consultants, a registered investment advisor and separate entity from LPL Financial. Today's guest, Rick Fisher, is a financial advisor with Ostro Financial Consultants, National Planning member SIPC. And now, Beyond Investments, here's your host, Seth Leishman.
Good morning, and welcome to Beyond Investments here on News Talk KNCO, AM 830. Seth Leishman, as well as Nathan Leishman here from Ostro Financial. We are excited to be here on the show today. Start of another weekend. End of a solid week. Beautiful weather in Nevada County. Nathan, welcome to the show. Thanks for filling in for Rick. Rick being on vacation and enjoying some time off. I think Rick will be back next week, though, as co-host here of the show. Nathan, thanks for filling in.
Yeah, thanks for having me. Love being here.
We do want to point out, of course, since Rick is not here, I want to point out that the San Francisco Giants are on a 10-win streak, have passed his beloved Los Angeles Dodgers for second place in the standings. I don't know how long that'll last, but we got to rub it in when we can.
That's right.
Nathan, markets have been a little choppy lately, and we've had a lot of news coming out about various things like inflation numbers. We got another Federal Reserve comment and pause, so to speak. There, a break. We're getting a little break in the increase in interest rates. They did indicate, though, that they weren't done. That there was, of course, more possibility, if not even probability, of continued rate increases in the future.
That's correct. Yeah. So we saw that last rate hike. So now the Fed funds target range is 5% to 5.25%, which is pretty amazing when you think that a year and a half ago we were at 0% Fed funds rate. So over a year and a half, we've gone from 0 to over 5% for the Fed funds rate, and that's had an impact on a lot of things. Mortgage rates are up, rates on savings accounts are up.
Yep.
So you kind of have both sides of things affected by that, and the main reasoning behind that is the Federal Reserve uses what's called monetary policy to achieve their two main goals, which is to keep inflation at 2%. That's their long-term target, and to maintain stable employment. And sometimes those goals are at odds with each other. But if you remember, about a year and a half ago, we started seeing inflation pick up, and it peaked in June of 2022 at just over 9%, which was the highest since the early 80s, so in over 40 years. Since then, we started to see the inflation numbers, consumer price index, start to slowly come down. And the most recent figure in April was 4% for the headline inflation number. And so essentially the Federal Reserve came out in this last meeting and said, after doing 0.75% hikes this year in 2023 in the first 5 months, they said, okay, we're going to put a pause. But just sort of reading the news, I think most of the people that look at this closely are saying that the Fed chairman, Jerome Powell, is essentially saying, hey, we could see more interest rate hikes. So he hasn't said we're done. There could be possibly more. And I think he's kind of leaving that out there just to give himself that room, because even though we're at 4%, that's still significantly higher than their 2% long-term target. And so we'll see where that goes. And so these higher interest rates have they slow the economy down because it makes it more expensive for companies to finance their operations. So companies aren't going to be spending as much, and then consumers aren't going to be buying as many things on credit.
Right.
And so the thought process behind tightening monetary policy is to make things more expensive from a debt perspective.
Yeah, that slows things down, definitely. People second guess, that next large purchase. They'll reconsider getting a home equity line of credit to finance a major remodel on their home. When you combine the higher interest rates plus the inflation of the costs of goods having gone up so much, I think you're absolutely right. The Fed's in a spot where they're looking at it and they want to pause because it has slowly and yet stubbornly kind of come down a bit. Still nowhere near where it needs to be and where it was just a few years ago, but you don't want to slow down the economy down and push it into a recession. That big nasty R word, recession. We want to avoid those as much as possible. Some things are just unavoidable. When we're at extremes in our economy the way we have been recently, there's a good chance that we could possibly see a recession coming up in the next little while.
Yeah, and so that kind of ties into, like I said, their other mandate is employment, and so far the numbers have held up, but certainly that risk looms if they continue to raise interest rates. So I think they're trying to balance a pretty fine line here of avoiding inflation getting out of control again, and at the same time not tanking the economy. So I think if we saw things get significantly worse, I imagine we'd see the interest rates come down in response. So we'll see. We'll
see. Yeah, absolutely. I mean, it's they've raised them consistently now for over 2 years, and at least that gives them a little bit of ammunition in the future for possible rate decreases should things really slow down. That was a position that the Federal Reserve has been in, where they haven't had any real good tools to use because they had interest rates at essentially zero. And if you wanted to kind of spark the economy and get things rolling, if it were to slow down, they were out of tools. And so then we ended up having things like, these types of situations like COVID-19 pandemic, and we want to spark the economy a little bit to get things going again after such a big slowdown and shutdown. And what do? Because you can't lower interest rates any lower than they already are, you end up doing things like pumping trillions of dollars of government debt, because obviously they don't actually have the money. I love it when we use government spending. They spent. I don't know if it really counts when it's money that you didn't actually have if you call it spending. So government stimulus, same thing. When you borrow, you're borrowing money at pretty low, reasonably low interest rates to then just dump into the economy to try to grow it. Not really the best way long term, in my opinion. Right, to have a sustainable fiscal policy around having a growing economy and keeping it in the positive versus to avoid things like recessions is by financing government spending. Not really a great strategy long term. Can only go at that rate for so long. And here we are today at well over $30 trillion of just federal debt. Let alone tack on state, local, cities, all that kind of stuff there. Personal. Yep. Then you really start to look at things with personal debt and whatnot. So, as we think about recession, we think about what is ahead with interest rates, with inflation. Market seems to be somewhat resilient. We had a real big pullback, of course, in 2022. And then a pretty reasonable rally so far this year in certain sectors of the market. It definitely feels like, the higher risk or the higher growth side of the market has actually outperformed the less historically the less risky side of the market. So we have things like technology up a lot, NASDAQ, a lot of the stocks within the NASDAQ are outperforming some of their competitors, if we call them competitors. Things like dividend paying stocks and utilities and some of these things that are more, historically conservative. They're outperforming this year.
Yeah, we've seen kind of a reversal from what we saw in 2022. And I guess looking even further back in 2020 and 2021, of course, that included part of the downturn, from March to May or June of 2020, where the pandemic was just starting, and across the board we saw a sell-off in assets, and then pretty quickly started the recovery, and from there forward all the way through the end of 2021, it was really the technology, healthcare sectors, especially the more growth-oriented parts of the sector, that were really doing quite well. And a lot of those companies were those that are not as impacted when they started shutting down. People going out, like the retail sector, for example. If you're not allowed to go out or significantly restrained from going around large crowds of people, companies that do most of their business online or are software oriented did really well during that time period. Then come 2022, things are opening up, and we've seen somewhat of a pullback last year, where the growth stocks that had done really well in the latter part of 2020 and all through 2021, that trend reversed, and actually the dividend paying stocks and more value oriented parts of the stock market outperformed, and so that was 2022, still down across the board. So bonds, stocks, growth, value, across the board we saw declines in 2022 as inflation started to pick up and interest rates started to rise. I think that was the main driving factor for the declines in stocks and other asset classes last year. And then you're right. So starting 2023, we've seen a reversal. So whereas technology was the worst performer last year, it's now the best performer. If you look at that as an area of the market, the more growth-oriented stocks have outperformed what we'd call the value or dividend side of the market. And I think we'll see. I think as the inflation numbers have come down, that might be encouraging to the market that we won't see as large of increases in interest rates as we saw before. But I think we've seen a lot of volatility, and my kind of personal take on that is I think the market might not be ready to get too excited.
Yeah.
They've stopped the bleeding a little bit from last year and started getting a little bit excited, but it's been kind of up and down this year. Definitely up from the beginning of the year, but we've seen a lot of volatility, and I think that a lot of that has to do with the inflation numbers, and if that's really sustainable. They've come down, but will they stay down?
Yeah, that'll be an interesting dynamic to see, as well as the long. I think the market is also still digesting the what if scenario of what if interest rates don't come down anytime soon. What does a 6 to 7% mortgage rate do to the real estate market for the next 10 years? What if they stay? What if they're that high for the next 10 years? What if corporate financed debt is going to be in that 6 to 9% number as well, and things like that. And what's going to happen to stocks when demand to buy stocks is lower because of the fact that you can put money in a three month treasury bill or a high yield online money market at almost right at about pretty dang close to 5%. an average investor may say, I just don't want the risk of the market. I'd rather just park it here for 5% and earn 5%, which they have been able to do since like 2006. I mean, it's been a long time, long time since we've seen safe, conservative, essentially money market pay a much more reasonable or rational kind of interest rate. So why don't we take a break? We're going to come back and talk more about some more of the market trends and what's going on. You're listening to Beyond Investments right here on News Talk AM 830. Welcome back to Beyond Investments here on News Talk KNCO AM 830. Technology outperforming. Rick and I, a few weeks ago, for listeners who tuned in, talked a little bit about artificial intelligence and some of the pros and cons and some of the things that are out there with that. And what's interesting too is when you look at some of the technology outperformance, it's not just startups that are kind of getting into that space, kind of disruptive technologies, we'll call those, right? It's not just the disruptive technologies of the startups. It's Microsoft's at nearly an all-time high. Apple just touched their all-time high this last week. You've got large tech also participating in a lot of this. It's not just the small startups, which has sometimes been the case in the past anyways, where you've had, some of these companies with, disruptive technologies messing with the big guys and their stocks go up like crazy. I think we've seen a lot of large tech as well doing pretty darn well.
Oh, absolutely. I think that's probably been the case for sure. And looking back historically, we've written about this in some of our newsletters. Is if you look at the top 10 companies in the the S&P 500, for example, the 500 or so largest companies in the U.S. and publicly traded. And if you were to look 30 years ago, you wouldn't have seen the makeup that you see now, where 7 or 8 of the top 10 are technology companies. Yeah. And so it's kind of interesting, and as a percentage of the market, we've seen technology become much more important, and they're still considered. I would still consider it a growth sector, but we also have to keep in mind that Apple, like you said, Microsoft, Google, these aren't startup companies, and these are companies with very strong balance sheets. Many of them net cash, so more cash than they have debt.
That's right.
So very conservative on their balance sheets, very profitable. Yep. So I think, if you were to...
A lot of them started paying dividends.
They're paying dividends, yep. So even though they're still growing, so it's a sort of a different makeup within the technology sector, especially if you look at the larger companies, which make up the majority of the index for the technology sector. Right. They're much more mature than they were if you look back at the boom bust that we saw in the early 2000s.
Early 2000 with tech boom and bust there. Yep, absolutely. No, these things they're a lot more mature. Yep. They've got, you're right, balance sheets that are a lot of our large 100-year type, been around for 100-year type companies would almost be envious a little bit of some of these balance sheets. Yep.
The Exxon Mobil's or the companies that you would have thought 20 years ago would have been the largest.
That's right.
In the index.
They've all been surpassed.
Yep.
And they were, the 3Ms, the Exxons, the IBMs even, which is a technology company, of course, but still been around for a long, long time. The Coca-Colas, some of the financial stocks out there, right? Some of the B of A's and the Wells Fargo that were huge parts of things like the S&P 500 index. Yep. Are now gotten pushed down a bit. They're not in the top 5, not in the top 10 anymore, as these more mature technology companies kind of take over that space.
Absolutely.
When we think about the future of the market and future of our economy coming out of a pretty rough 2022 and looking at a 2023, there's still a lot of uncertainty. A lot of uncertainty about how we're going to address things like, debt, national debt, corporate debt, what's going to happen with tax code changes, what's the possibility for that. And then we've got another presidential election coming up next year. And you've already got a lot of, politicians announcing their desire to run for president. We've heard, at least he said it. We'll see what happens. But President Biden has said that he does plan to run again. We'll see if there'll be any Democrat challengers to that or not. Historically, you don't usually get much of a challenger at all when an incumbent is running. But on the Republican side, you've got already several people who have announced their candidacy, including like a Ron DeSantis out of Florida, who's announced his, and quite a few others as well. So it'll be, presidential election years are always kind of those up and down kind of things that can oftentimes surprise us, and so I think investors need to be cognizant of that. But let's come back to look to talk more about interest rates and talk a little bit about more around things like what investors can do to be safe and what's out there, and what can they do to manage their allocation in a more conservative way.
Yeah, great question, because I think, there's a lot of risks here that we've been discussing about these higher interest rates, like the refinancing of debt. And some of that has some longer term, we might call tail risk. There's the initial impact of higher interest rates, but you also have to keep in mind that it will echo through several years here. Right. As, because the average length or maturity of corporate debt, for example, is not a year. Right. It's it could be, 5 to 7 years. And so as those debts mature, they're having to either refinance those or make changes to their business. That's right. And so there is a sort of a time lag between when those interest rate hikes happen and when we actually see there's sort of the initial impact, but then there's going to be additional impacts that continue to echo through time. So that being said, that's a risk that we're looking at, especially going forward, and what the impact obviously on real estate prices we discussed. We haven't seen they're coming down. We saw the number 3% down year over year. If you look at the median house for the country that came out today, yep. That's not a significant decline. No, considering the magnitude of the mortgage rates hike. Oh, I mean, hundreds of dollars a month higher payment for the same price house. That's another risk, as that starts to flow through the real estate market. So what can we do? There's also the flip side of this. So we've got the debt becomes a burden, but at the same time, we have, the low risk, short term, yielding assets, are now actually attractive. Whereas for over a decade, 15 years or more, 15 plus years, you couldn't get high interest rates on short-term, low-risk, fixed income. That's right. And so, a good example of that is kind of what you had mentioned, comparing what you're earning on your checking account with what you can earn in a high-yield savings account. Yeah. A year and a half ago, the difference was less than 1% for sure. For sure. You were talking pennies difference. Yeah. Yes. So now you're probably earning nothing or close to nothing on a checking account, because that pretty much never changes. That hasn't changed. Yep. But your high yield savings, so if you like an online bank, FDIC insured, of course, always be sure of that. Be sure, watch out for that. But those are between 4 and 5. 4 in the high 4s, approaching 5% now. Yeah, they're pretty. It's gone up a ton. So that's something to keep an eye out for, because I think a lot of people have gotten a little bit lazy around their cash management, where they say, hey, I can earn nothing in a checking account or nothing in a savings account. So, or very small the difference. That's right. That's changed now. So if you've got, a large amount in a checking account just sitting there, and you want to keep that cash there, consider some higher yielding, similar assets like a high yield savings account, for example. Yes. At least a portion of that. And so what we see with a lot of our clients is, they'll keep enough in their checking account to meet their spending needs.
Right.
And then for the rest of their, rainy day fund, which might be 3 to 6 months of your typical living expenses that we typically advise people to keep, you might keep that in a high yield savings account, because that's not something you need to pay down your credit card every month or something like that.
That's right.
And so that's a good way to earn some additional interest on money that would otherwise, just not be earning anything.
Yeah, it is a changing dynamic with that, because it's been so long. We have become lazy, just because and I want to say lazy, but there's just been no other option. So it's like, I think the average person just said, well, I'll just leave it in my bank and they were right to do so. It really wasn't worth spreading around and looking at other options, because they were all paying essentially zero anyways. But now we are at this point where you can get between 4 and 5% on something that's still insured and that's still protected, that's zero risk, still liquid and accessible, fully accessible and liquid. So now's the time to start looking for those other options, because why leave it sitting there with, for one of the big banks or even one of the small banks, whoever's paying you zero, whoever it is, because they almost all are. Don't leave it alone there just to sit there and earn zero. Be aware that there are better options out there. And, when you think about it, it's a big gap difference there between earning, zero and earning 4%. Because if you've got, $50,000 and it's sitting you've got 50 grand sitting in the bank, just sitting there doing nothing. And yet, if you were to look at something earning zero interest, and you look for a high yield savings account, and if you're in the mid 4s, that's $2,200 a year in interest. I mean, that's nothing to scoff at anymore.
Yep.
That's not $20 worth of interest. You're talking over $2,000 in interest for something that was going to sit there anyways.
Yep. Yeah. Another 200 or so a month.
Yeah, exactly. Exactly. Yep. So it could be a good income source. You could actually take that interest and use it, or you can continue to compound it, and leave it in there. There's just so many, there are options out there now, to have some level of yield or income or interest that we've been kind of complacent to, because we've been stuck in such a low interest rate environment for the last nearly 20 years.
Yeah. Yeah.
Well, as we wrap up here, Nate, I want to say thank you for coming in and filling in and having some good time here. We're talking about the markets and what's going on. And want to also encourage any listener there, you can go to our website at austrofinancial.com. Click on the news link. This show, as well as previous shows, are available. And as always, if you'd like to learn more, give us a call at 273-4425. Come experience the difference when you think beyond investments.
Information provided is for illustrative purposes only and does not constitute investment, tax, or legal advice. Information has been obtained from sources that are deemed to be reliable, but its accuracy and completeness are not guaranteed. Neither LPL Financial nor the hosts of this show or accept any liability for the use of the information discussed. Consult with a qualified financial, legal, or tax professional prior to taking any action. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Austro Financial Consultants, a registered investment advisor and separate entity from LPL Financial.